What's up guys, Jake here. In this video, let's do a tutorial how to sell covered calls on Robinhood's platform. In the event you're pretty new to trading options, I highly recommend checking out my playlist on trading options. You can start right here at the beginning, but a video you might want to watch is how to sell covered calls, options trading explained. I go much slower and more into detail with the terms and the possible outcomes. But in this video, let's do a live example together. And before you can sell covered calls, you must first own 100 shares of a stock. That is what makes it covered. Robinhood is not going to let you sell naked calls where you don't own the stock. So to do an example, let's do Bank of America Corp. I think generally this is a good stock to own long term. If you're selling covered calls, this should be a stock that you're comfortable holding 100 shares of long term. In addition, if you're going to sell the covered call, you should also feel comfortable selling it for a higher strike price. So the contract that we're selling is going to be out of the money, meaning it's above our cost basis. So in this video, I'm going to buy 100 shares of Bank of America Corp for about $4,022. As long as I'm selling a covered call with a strike price higher than $40.22, then I'm guaranteed to make money. I cannot lose money selling a covered call when the call that I'm selling is above the strike price for my cost basis that I paid for the 100 shares. And when selling covered calls, you kind of want to be strategic about what stocks you pick and when, so let's do a little bit of technical analysis on Bank of America Corp. It's been consolidating in this range between $38 and $43 for over 6 months now. The moving averages are all converging. This purple line is the 200-day moving average. When the 200-day moving average catches up to the current share price, there's a good chance that Bank of America Corp could have a breakout. However, I don't see that happening in the next month. It's going to take longer than a month for this 200-day moving average to catch up. So I want to buy 100 shares of Bank of America, and then I'm going to sell a covered call for this strike price of $42.50. I don't think the share price is going to get above $42.50, and I want to make money. I want to collect premium and get paid today just for holding the stock. Now, is it possible it could break out above $42.50 by my expiration date? Sure. If it does, do I care? Not really. I'm willing to sell this stock for a profit plus the premium for the contract just by holding it a month. So back on Robinhood, let's just go Bank of America, and we're going to purchase 100 shares. I'm just going to do a market price to get it done. We'll review order and execute. Okay, back to my main page, and I have 100 shares of Bank of America Corp. This is actually the only thing now that I'm holding in this account. That's why my chart looks a little weird. We're going to click on this to then find the option chain. And over here on the right, it says Trade Bank of America Options. Make sure that you're approved for trading options with Robinhood. But we're going to click on this in order to pull up the option chains. Now, to find the contract that you want to buy or sell, you have to make a couple decisions. So at the top, first thing I recommend doing is changing the expiration date. It's currently September 15th, so it's default showing you the most recent contracts expiring. I'm going to go with October 22nd, which is the third Friday of the month, usually has the most contracts buying and selling that day. And it's about 1 month in the future. When selling covered calls, you want to sell in this time period of about 1 to 2 months to get a good premium. And if you want to buy to close later, you can kind of time when you exit a position for a profit. I like giving myself a little bit more time than just, a week or two. Some people will sell weekly contracts, but I feel like the chances of you getting unlucky for a smaller premium is much higher. But at the top, we have buy and sell, we have call and puts. We're going to be selling a covered call, so select sell and call. You're then going to scroll down to find this green line, which is the divider. Now, when selling a call, If it's above the green line showing the current share price of $40.22, these contracts are called out of the money. And if it's below this green line, then these contracts are considered in the money. You can sell in the money covered calls, but personally, that's not the strategy I'm going to explain in this video, and I'm not going to recommend it to you if you're brand new to trading options. So when we go back to that chart, we were saying that there looks like there's a resistance line at 42.50. So I want to sell a covered call where, as long as Bank of America Corp stays below 42.50 in 37 days, then I'll just be able to make money and keep my 100 shares. That's what I want to do. So on the left side here, we're seeing the strike prices. This is the agreed upon price that buyers and sellers are changing hands when buying and selling these contracts. So the current share price is 40.23. We have a strike price of 41. Something you might want to reference when you click on that strike price is the Greeks. And on Robinhood, they call it the chance of success, I think, or the chance of winning. I don't know. But here you have the delta value, and the delta value shows you the rate of change of the option premium per $1 move in the share price. So delta is 43, and it roughly gives you the probability of the share price of the company expiring with this contract being in the money. I know that was a lot to say, just hang in here. But that 0.43 represents roughly, according to the Black-Scholes formula, a 43% chance that you'll be exercised on. Your 100 shares will get taken from you. However, you're paid the strike price. You're paid $41 a share. So let's think about it. If I just purchased these 100 shares for $40.24 a share, I just paid $4,024. However, if I sell a covered call with a strike price of 41, I'm selling them to somebody in a month if I get exercised on for $4,100. As long as I've chosen a strike price above my cost basis, I cannot lose money. However, I would like to buy these shares and hold them, so I'm going to sell a covered call with a higher strike price, in this case $42, with a lower delta value, 0.32. Now, the lower delta value means I'm going to get less premium. This value over here, 71 cents, is 71 cents per share. Multiplied by 100, I can make $71 in a month by selling this covered call with a strike price of 42. Now, the closer you get to the current share price, I could have gotten $109 if I went with a strike price of 41. So I don't really care. I'm comfortable losing the stock. I'm comfortable holding on to the stock. But I like selling covered calls with a delta value of 0.32 and an option premium of $71 for basically no effort on my part. Holding this for a month, I think that's a good rate of return. So let's select a strike price of 42. Now, Robinhood is going to give you a break-even price. The break-even price is $42.71. That is the strike price plus the premium you're getting paid. So you're not net losing value on this covered call unless Bank of America Corp by expiration gets above $42.71. So whenever you hear about people buying options or selling options, who has the advantage generally? Generally, the seller has the advantage because they always have this break even above the strike, which is the premium they were paid by the buyer of the contract. So let's go ahead and execute this trade. All you got to do is click on the plus icon. Robinhood will then populate it up here. And it's telling me that today I will receive a credit of about 71 cents. Now, once again, this is multiplied by 100. So I'm going to receive a payment today of $71. Pretty sweet. I'm going to click on continue. Robinhood is going to ask how many contracts, obviously just one because I only have 100 shares. It's then going to say, do I want to put in a limit price? Other brokers will allow you to do a market trade. If you do a market trade, it will go precisely to where the buyers are bidding. So buyers are bidding 69 cents a share. Sellers are asking 71. Robinhood automatically populates it in the middle. So if you review and execute this at the mid price, it might take time for it to get filled. If you execute this, you might want to come back in an hour, see if it got filled. It might not if the share price is moving on you going down. If Bank of America Corp is going down, then these buy and ask bid prices are going to shift and your mid price will become the high end basically. I want to make sure that this gets executed on. So I'm going to type in 0.770. So this is lower. I'm getting $1 less than the mid price, but I want to make sure it executes for this video. So I'm going to hit review order. Okay, my order executed and filled exactly as I requested it at $70. So you'll notice that my account balance did increase by $70, but the value in the account didn't increase. The reason why is because when you sell a covered call, that contract still has value. It shows up as in other brokers as a -1, and it has negative value until it expires worthless or you buy to close it. If you want to exit this position, you can do this at any time by buying to close. It even pulls it up to you when you click on it. So let's look at the stats of this contract just so you can familiarize yourself. Expiration day is October 22nd, about 37 days in the future. Tells me the break-even price and contract, -1. So a way to think of this is in your account, you have a -1 balance because you were the seller. If you want to exit this position, you have to buy this exact same contract, expiration date, and strike price to get this to a 0. Once it's at 0, you have no obligation. You're not at risk of buying 100 shares or losing 100 shares. The credit I received is $70, and eventually it'll show you stats over time as this contract value goes up and down. Don't be freaked out by large swings or large percentages. The most you can gain is the premium you received. So the most I can make on this option contract is $70 in a month. However, if I do get exercised on, remember that you're selling those 100 shares for higher than what you paid for them. You still make a profit from the capital appreciation of Bank of America going up in price over 1 month. Now, if at any time I want to get rid of this contract, all I have to do is buy to close it. So I would type in 1 because I currently am showing, remember, that -1. So I'll be buying a +1, and then you have to put in the limit price. Now, my cost basis was 70. I received 70. I have to pay back 70 to get rid of it, get rid of the obligation as a seller to get out of it. But what if I'm way off and Bank of America share price starts going up in the next month? The value of this contract is going to increase as it starts gaining extrinsic value or intrinsic value, retaining extrinsic value. So the limit price is going to keep going up, and I might net lose value if Bank of America, for some reason, shoots up to $45. Once again, I'm still comfortable doing that. You can't really lose selling covered calls if you're comfortable selling the stock. Just the final point I want to make with you guys when dealing with covered calls on Robinhood. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, check out that entire playlist on trading options down below. Lots of great tutorials about other options trading strategies. Till the next video, take care.